Hello, my fellow Westover clients. I have not been visiting with you often because things have been running so smoothly. That was, of course, until the Trump tariffs took effect. So I want to rant a little bit, vent about those tariffs, but I also want to talk to you about how we navigate market volatility among tariff impositions. If you haven't read it, you should go to today's Wall Street Journal and read the lead editorial about tariffs, because it captures the concerns I have, and with apologies to you for not looking you in the eye, I'm going to read from some parts of that editorial. Quote, President Trump won the presidency a second time by promising working class voters he would lift their real incomes, which makes it all the more puzzling that he's so intent on imposing tariffs that will punish those same Americans. Tariffs are taxes, and Mr. Trump's latest tariffs are estimated to be about an annual $150 billion tax increase. Taxes are anti-growth. With all due respect to Mr. Trump, he should go back and take a class in economics. As Warren Buffett said, who do you think pays for the tariffs? The tooth fairy? So I'm a little upset that the leader of our free nation is so determined to impose an anti-growth, anti-worker policy, but it is what it is. So we've got to deal with it. The analogy, when I say we've got to deal with it, here's the analogy I have. The economy and all the events that happen are a vast, wide ocean. Think of the Atlantic Ocean. We're on a very large boat, an ocean liner, having left the harbor in New York, going to London. When we set off, everything's great. Sun's shining. That's been the last couple years. The seas are calm. That means no volatility. Everything's cool. The disruptor wins the election. He is a disruptor in every sense. He is anti-establishment. Now we're in the middle of the ocean. There's no land around. We can't get to a harbor. And the rains come and the winds howl and the boat starts to rock. It's not gonna upset it. It's not going to turn over. It's just going to rock. That's where we are right now with tariffs. So how do we navigate these seas? Well, first we have to understand that market volatility and tariffs are not new. Fluctuations in the market have been part of investing, and tariffs have been one of the many factors that contribute to short-term volatility for ages. Short-term volatility has been very strong the last couple of days. The market has fallen strongly. To that end, the S&P gave up all of its gains for the year over the last 3 days, not counting today. Today is March 5th. And the Dow Jones is down 3.4% for the year after being up in the middle of February. But we've seen similar economic pressures in the past, as I said, from trade disputes, from geopolitical tensions, and from inflation concerns. And time and again, the markets have demonstrated their resilience and their recovery. I believe so strongly in our free market system here. It's the best system in the world. Democracy, freedom, liberty, they go together, and that's why we are still, to this day, the strongest country in the world, and will always be, I hope. But history does tell us that tariffs can temporarily disrupt certain industries, disrupt certain supply chains, To that end, it's estimated now that if these tariffs stay in effect and you want to buy an SUV, congratulations to you, it will cost you $8,000 more. It goes all the way down to the Corona that you want to drink. It's going to cost 30% more. What is going on here? Anyway, so what's our approach? Well, we take a long-term perspective when we have issues like this, and I guess that's good. I also want to talk about volatility in an historical context. I started this business in 1999 in November. For the next 3 years, the market was negative every single year. It was down 10%, then 13%, then 23%. And of course, we all remember, but we still got by, and we still had clients, and we just provided them wonderful service, and they stuck with us, and all the better. Then we had, of course, I'm sure you remember the 38% drop in the market in 2008 because of the financial crisis. Same thing, we get by. So how do we do that? Well, rather than reacting to this short-term noise, tariffs, we remain focused on fundamental principles that drive strong portfolios. You've heard me say this, you've heard Matt say this, you've heard Chip say it, Steve say it. Our first core principle is diversification. Our portfolios are structured deliberately to withstand different market conditions, including the present ones, by spreading the risk across various asset classes: stocks, bonds, cash, alternatives like gold, and by spreading risk across sectors. So all 11 sectors of the economy are the sectors we invest in. We don't overweight unduly any one sector. And we're also diversified across global markets. So we don't limit ourselves to the United States. We look to the entire world to find investing opportunities for you. We don't limit ourselves to large caps. We look at small caps and mid caps. We look at value stocks, and we look at growth stocks, and we look at those that are called blend. So you are fully diversified, and if you think of pistons in an engine, when one piston is down, another piston is up, and that's what protects your portfolio and drives it forward. Secondly, we believe in quality investments. We focus on companies with strong balance sheets, competitive advantages, and those which have a history of navigating economic uncertainty successfully. Chip runs the screens that we have created here at Westover. They're proprietary, and we've been working on them for more than 25 years every day, and he finds good, appropriate companies to buy in the economy of the day. So what that means today is we're going to be looking at more defensive-oriented opportunities. And we also look at what we call strategic adjustments. While we don't react emotionally to market swings, and I apologize for my rant, we do remain proactive in identifying opportunities and adjusting allocations as necessary. So to the adjusting allocations as necessary piece, you will remember, if you've been with us this long, that when the financial crisis hit, we reduced everybody's asset allocation. With respect to being when I said being proactive in identifying opportunities, when markets fall and we have good companies we have been following, then they have put their price on sale and we buy them. So that makes a lot of sense to me. So I think overreacting to headlines or making knee-jerk investment decisions will only lead to unnecessary losses. Again, I'm going to look at a chart, so my apologies for not looking you in the eye. I apologize, I've got a lot of notes. Okay, this is from our economic market outlook that we prepared in 2024. I don't think this chart is in your slide deck, but we have put our economic market outlook for 2025 in your portal, so please take a look at it. So this talks about staying invested for the long term, notwithstanding what happens on any one day. So from 2004 to 2023, that's 20 years. If you had invested in the S&P on day one of that 20-year period and had stayed invested for the full 20 years, never once taking your money out, your return would have been 9.7%, a very good, strong return. If you had jumped out of just the top 10 days from the market and had stayed invested in every other day, your return would have been halved. You would have had a 5.5% return. And if you had jumped out at the top once per year, that is, you'd missed the 20 top days, your return would have been 2.8%. So, point, you've got to stay invested. That's why staying the course is so important. Those who sell in fear almost always lock in their losses and miss the chance for recovery. As I said earlier, market downturns create opportunities. Volatility presents chances to buy high-quality investments at lower prices and positions portfolios for future growth. So, final thoughts. Your financial plan is built for this. Your assets are protected. Your goals haven't changed, and neither has our commitment to guiding you through market fluctuations. While no one can predict short-term movements, you and I can control how we respond. That's why we continue to rely on well-structured, research-driven investments that are designed to weather storms and capitalize on long-term growth. Again, I apologize for my rant, but I'm just astounded at the ignorance of some of the people in Washington. I hope that policy will be reversed sometime in the future, and I'm sad if it is not, because it will lead to inflation, it will reduce jobs, not add jobs, and it is what it is. I'll leave you with one thought on that point that Chip left with me yesterday. He said, hey, Pops, he calls me Pops, how would it be that if you moved manufacturing facilities from a low-cost provider, Mexico, to a higher-cost provider, the United States, that you would get reduced prices on the product that's manufactured here? No, it doesn't work that way. It was a rhetorical question. So in any event, if you have any questions, if you want to discuss your portfolio in more detail, I'm here for you. We're all here for you. We thank you for your value and your trust and your confidence. We're going to navigate this together. It's just a short-term blip. Like I said, we've got a phenomenal country here. The free market capitalism concept is the best in the world. We will always be successful, and we're just right now out in the middle of that ocean being blown a little bit. But the ship is still sailing well. Take care. I'll see you.